Good afternoon, ladies and gentlemen, and welcome to a Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. My name is Ketwe Kunene, and I'm the coordinator today. And we are talking your investment tax benefits before the 28th of February today with Errol Mayer. But since this is the first webinar of 2019, compliments of the new season to you all. We hope you crossed over to 2019 in a very graceful manner, and we hope 2019 brings you lots of joy. Since it is the first webinar of the year, we'd like to make sure everybody is comfortable with how webinars work, as this is the first one. And those of you who might have forgotten as to how it works from last year, this is just a reminder. You're going to be with us for about 45 minutes to an hour. Errol will take us through the presentation, and then at the end, he'll address questions that you might have. So first of all, I'd like to make sure that everybody can hear me and that the sound is good on your side. How you do this is you just click on a small high five. There's a small hand on the panel on the right-hand side of your screen. Looks like a high five. If you click that for me, then I will see that you can all hear me and we can carry on with the session. I'll just wait for you to find it and click it for me. Thank you, Viten. I see yours. Thank you, Debucho. Thank you, Sean, Ruben, Richard. Okay, the high fives are coming up. Thank you, Mohammed, Mohomoto. All right, the majority of the high fives are coming up. Some of you are still finding it. I appreciate you all. So that's the first part. If the volume is not loud enough for you guys, on the bottom of the screen on the right-hand side, you've got a taskbar. Just find that sound little app thing that looks like a volume. You just click that and you put that as high as you need to, and the sound should be clear for you. That's the first matter. Second matter is questions. You might have noticed that you're all muted so that we don't have sounds coming through from all over the place, which disturbs the presenter. How you ask questions is on the very same panel where you found that high five. There's a questions box where you can type in the question. Anytime you have the question during the presentation, you type in the question. We will not address it immediately, but at the end of the session, Errol will take the questions for you and give you the answers and feedback. If you're too slow, then you just email us. You'll get a thank you note afterwards. You email us the questions, and I'll pass it on to Errol, and we can always send you the response afterwards. Okay, so let's get to the business of the day, which is talking about our topic, and Mr. Errol Mayer is going to be doing that for us. For those of you who don't know our resident speaker, resident DJ, Mr. Errol Mayer, let me tell you a bit about him. Errol Mayer is a certified financial planner and admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estates and Financial Plans, which is now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He has previously worked as a legal advisor for corporates and as a tax advocate for SARS. And he currently holds the position of advisory propositions legal specialist here at Standard Bank, which is why we trust him so much with our topics. So Mr. Errol Mayer will be going through the whole presentation for us today. I hope you enjoy it. I'm going to hand over to Errol to then take over for us. Hello, Errol.
There we go. Thank you, Katiwe. Good afternoon, delegates, and welcome to our first webinar for 2019. I see we've got Julian Felix on the line, John Ford, and I recognize some of these names. Well, as an introduction, Davos hosted the 2019 World Economic Forum, where the foremost political, business, and other leaders of society met to shape global, regional, and industry agendas. The fourth industrial revolution was high up on the agenda, and we are on the brink of experiencing how artificial intelligence will change the way that we conduct ourselves. Now, at the forum, Cyril Ramaphosa was quoted as saying the following, and I quote, "I am a fisherman, and here in Davos, we've been fishing for investors. I'm confident we'll come home with a bag full." Now, Cyril Ramaphosa skillfully delivered a message that South Africa is on a path of growth and renewal. Looking back, there is no doubt that progress was made and hope becomes a reality again. Now, this seems to be the general view of astute South African businessmen who attended the World Economic Forum. On a more practical note, one of the discussions centered around drone deliveries that have the potential to completely change the face of global logistics. Just think how the use of webinars made information accessible to all in a speedy and an efficient way. Having that said, the topic for today is claim your investment tax benefits before 28 February 2019. Now let us start off by giving some content to the topic. Taxpayers must declare all their income received in a year of assessment which ends on the 28th of February each year. We know that limited tax relief is available for salaried employees since they do not incur expenditure that is trade or business related, like a businessman. For example, taxpayers receiving trade income may claim business expenditure as a tax deduction. Some salaried taxpayers may receive more income, for instance, renting out a flat, but usually trade expenses are limited to the rental income received. In this online seminar, we will discuss tax breaks on investment income, albeit in the form of income tax or capital gains tax. We will discuss the tax principles that apply to salaried employees, taxpayers earning a business income, or a combination. Now, interesting, investment income do not constitute trade income and is of a capital nature. Therefore, such expenditures, such as investment contributions and capital proceeds, do not qualify for tax concessions, income tax or capital gains tax, but for only in two instances. These two exceptions are retirement annuity funds and tax-free investment savings. And these are the two that we will be focusing on today in more detail. We will be discussing in detail these two tax-efficient investment solutions and hopefully be able to show the value in making use of these tax breaks in an environment where cash flow is challenging for many households. Therefore, in this online seminar, tax savings on investments, cash flows, and goals-based financial planning processes are equally important. So let us explore what it is that we will be discussing. As said before, we will discuss the retirement annuity fund contributions and tax-free savings investments. Both investments qualify for tax relief. It is important to note that different tax considerations govern the two investments. Furthermore, if not more important, the point of departure is not where I can get the best tax saving, and this may come as a surprise, but how do I picture perfect the tax benefit with due regard to the purpose of my investment? Now, the purpose and type of investment, albeit a retirement annuity or tax-free savings account, will be closely interrelated to the savings goal. And the savings goal can only be set up once we consider the unique circumstances of a client, often referred to the risk profile of the client. A saving goal may be for future education, post-medical expenditure, etc., etc. In other words, tax savings do not dictate the type of investment, but the risk profile of the client and the tax savings are secondary. And that is very important. Emotions such as greed and fear often trick us to make the wrong decisions, especially when it comes to tax. And when it comes to tax, we are so gullible. Now, the purpose and type of investment will be closely correlated to the specific savings goal, and upon considering the unique circumstances of a client, only then the savings goal can be set up. Now, let's go through number one, tax year ending 2018-2019. What's the importance of this? Tax is payable for a historic year of assessment. In the case of natural persons, the year starts on the 1st of March and ends on the last day of February. The completion of a tax return occurs on a later date, but the liability to incur the expenditure must be within the same year of assessment, and in our instance before 28 February 2019. And this is why we are saying claim those benefits before the end of the tax year. The second point, definitions. To understand the two different tax vehicles, we will make use of a short, simple description, which I'll do later on, since it may help with understanding the purpose of the investment solutions. Thirdly, the best way to understand the tax, cash flows, and financial planning principles is to make use of a very simplified case study. Now, I made up a case study with the sole intent to illustrate principles as best as possible, with the result that it will not be indicative of a real case scenario. Rather, I wish to explain the fundamental principles without leading to too much complexity. The intention is thus to promote understanding and to avoid all complexities. Now, the fourth one, the why and financial planning. As said before, the purpose and type of investment will be closely correlated to the specific savings goal. And upon considering the unique circumstances of a client, the savings goal can be set up. Now, tax is payable for a year of assessment. Now, let me go back to the why. Persons who adopted the goals-based philosophy process as embraced by the Standard Bank Financial Consultancy will find that the process is simple to understand and serves as a safeguard against irrational tax and investment decisions. Now, number 5, it makes no sense to be tax-driven, and I've said this before, and ignore other requirements that may be of importance to specific circumstances. For instance, investors do not have access to the funds of a retirement annuity before the age of 55, but only in the case of specific and limited circumstances. Surely that is an important aspect to be considered when looking at the tax advantages of a retirement annuity. It would be foolish to invest into a retirement fund, obtain flamboyant tax benefits, but have no liquidity available for contingency purposes. Or if older than 55, only have access to 1/3 of the value of the fund prior to death. Now, I haven't discussed tax yet. So let's then look at slide 3. Sorry, I'm on slide, which one? I'm now on slide 4. I'm just going to go. Just give me a minute. Retirement annuity, tax year ending. That is slide 4. Am I right, Katiwe? Non-tax benefits and applications. Yeah. Sorry, just give me a minute to go back there. 1, 2, 3, 4, 5. So we're actually there on the 4th one. My apologies. The contributions, yeah, I'm on the contributions by 28th of February. Let me move on to that one. Taxes payable for that year of assessment. In the case of a natural person, the year starts on the 1st of March and the end of the last day of February. Now, tax returns are only completed on a later date, but the liability to incur the expenditure must be within the same year of assessment. This often creates a cash flow problem in case of tax-friendly investment income, since the actual amount must be paid before the 28th of February. If paid after the 28th of February, the expenditure will only qualify for tax relief at the end of the following year. Stated differently, if you snooze to contribute to a retirement annuity or tax-free investment before 28th February, you lose, and no tax relief will be forthcoming. Now let's go to number 5. Now, a major fundamental difference between a retirement fund contributions and tax-free savings investments is the treatment of excess contributions in a year of assessment. In the case of a retirement fund contribution, any excess will simply be rolled forward in the following follow-up years, and the taxpayer will be able to claim the deduction for such year of assessment. Not doing so will never cause hardship, since these tax benefits extend even after the date of retirement, and one may even offset excess contributions against any pension or annuity income. However, and very important, when it comes to tax-free savings investment, one must be extremely cautious not to contribute more than a stipulated amount, namely 33,000 per year. Should one contribute more, then a taxpayer will pay a penalty of 40% on any excess contributions. And that is important. If it's a retirement annuity and you have excess contributions, not a problem. You will never lose it. If it is a tax-free investment and you invest more than 33,000 or even more than a 500,000 lifetime that you're allowed, you will be penalized at 40%. So one cannot dare to make that mistake. Right. Now let's go into more detail as to what is a retirement annuity, and then we move on to a tax-free investment. Now let us simplify the definition of a retirement annuity before we do same for tax-free investment savings. A retirement annuity in its simplest form is a contribution to an investment fund held for your benefit until a certain age, usually a retirement date or death, whichever is the earlier. A retirement annuity is the same than a pension fund. The only difference is that you do not have to be employed by an employer. Therefore, employees may contribute to their pension fund as well as a retirement annuity. It all constitutes a retirement fund. Unlike a pension fund, where the retirement date usually coincides with your retirement from the fund, in the case of a retirement annuity, you can choose to retire any time after the age of 55. And that is an important feature for planning purposes. The contributions of a retirement annuity fund, they are tax deductible up to certain limits of 27.5%. But the tax is deferred until you reach retirement age. So at the retirement age, there will be a tax event. Now, deferred tax means tax is postponed until retirement age, where one will pay tax on the annuity after retiring from the fund. Now, as quid pro quo for these massive tax breaks on the contributions, certain benefits are available, but then certain restrictions are imposed. And this relates to your particular and unique risk profile. For example, the build-up in the fund is tax-free, but you have less control over when you wish to access the funds, the investment assets, and to whom you want to leave the benefits upon the death. So on the one hand, with the retirement, you get these huge tax breaks, but on the other hand, there are certain restrictions, and those restrictions must fit your profile. What is very important from a growth and a compounding perspective is that the build-up in the fund is tax-free. So with other words, compared to other investments which could be taxed in the fund, you have a better opportunity to maximize on that compound growth. Good. So let's then look at a tax-free savings, Thanks, Katiwe. So let us simplify the definition of a tax-free savings investment. A tax-free savings account or investment is like any other unit trust investment, save that the investment is quality approved by SARS, so that you are not taxed on the income or capital gains when you cash in the investment. So here we go. In an ordinary unit trust, the income distributions are taxed annually in your name, and upon the disposal of the unit trust portfolio, the capital growth is taxed as capital gains tax. If it is packaged as a tax-free investment, then the investment escapes the annual income tax as well as any capital gain upon the disposal of the investment. An important feature distinguishing it now from a retirement fund is that the investment is available upon demand. So if you want liquidity, tax-free investment is a no-brainer. If you are prepared to leave the funds at least till 55, you can't have access to it, then one should be looking at the retirement annuity. And I haven't touched on tax yet. So tax is not the driving factor. So an important feature distinguishes from a retirement fund, I said, is that the investment is available upon demand, but the same cannot be said for a retirement annuity, where access to the funds are only available at the age of 55 or death. And on top of that, only a maximum of 1/3 can be taken as a lump sum in retirement. So let us move then on to slide to the following slide 6. Have a look at the calculations. Now the question here is, a tax-free savings investment, is it a short-term investment, medium, or long-term? So if one would not save on tax, what is the point of taking out a tax-free investment? Now remember, if you're under 65 years old, you're entitled to interest exemption of 23,800, but here comes a very important aspect. No capital gains or losses is payable up to the first 40,000 per taxpayer per year. So only if it's more than 40,000 will you pay capital gains tax on any investment that's subject to capital gains tax. Now let's have a look at my example. In example 1, my total contributions were 33,000 for 3 consecutive years. Of course, I can make 33,000 per annum, which is 99,000. And let's assume my investment has grown at 12%, namely to 124,717. Therefore, I've made a capital profit of 25,717. But since the 40,000 is excluded, there is no tax advantage. The proceeds are tax-free in any event. So it seems to really obtain the benefit from a tax-free investment, we've got to look at longer-term goals, and that would suit the tax-free investment. So if we look on the right-hand side, let's assume if you use the same example, but the investment is held for 15 years, you would have contributed 495,000. And remember, 500,000 is the limit. It was 30,000, it moved up to 33,000, so the time period has changed a little bit, but it's more or less 15 years. The proceeds will, in this instance, have grown to 1.3 million, 77,858. Here, the capital profit is actually the difference between the 1.3 million and the 495. But the capital gain, according to capital gains tax, because only a portion is included, is 151,000 at the 45% tax rate. So therefore, in this particular example, if you made use of a tax-free investment, you will not pay the tax on 151,740. And all along, also no tax on the build-up, on the dividends, on the interest, which, similar to a retirement annuity, helps you with the compounding effect. And this is where the benefit of a tax-free investment actually kicks in. So the longer the term, the greater the tax savings. And those of you who deals with investments a lot, when you deal with the long term, you'll find that your portfolio is more heavy lean towards equities. And equities is the one where you have the capital gains. So therefore, those equities, those capital profits of those equities would not be subject to any tax. So now let us move on and just look at some other features. I'm just going to highlight and just summarize between a retirement annuity and a tax-free savings investment. When we said with a retirement annuity, upfront it's tax deductible. Tax-free savings account, there's not a deduction of the 33,000. You pay it with after-tax money. With the retirement annuity, you are using pre-tax money. Therefore, with a retirement annuity, you use pre-tax money, but you defer the tax and will pay it later on. With a tax-free investment, it comes out of your capital with after-tax money, the 33,000, but the proceeds would be tax-free. So the tax consequences is totally different. A retirement annuity we refer to as non-discretionary, and a tax-free savings investment is more discretionary of nature. With other words, meaning that liquidity. With the retirement annuity, you don't have the liquidity, you lock it in, because that is the purpose of the retirement annuity. And that's why you get the tax breaks, because government wants you actually to lock it in to provide for your retirement. The only thing is that these days, the retirement annuity with the huge tax benefits could be used for many other goals. Because of longevity, 55 really is not something to aim at. perhaps post-medical expenditure after retirement. So here we go. This is where retirement annuity now starting to change character, and there is more value to the use of a retirement annuity just to talk about retire. So I think up to now I've pointed out the question of which fund is best from a tax perspective is not the way to go. It is more about the fundamentals and then understanding the tax. So let us make use of an example where now what I've told you, I will just group everything together and explain the principles. Now the facts are very simple. Mr. X, 50 years old. Let's assume he receives a salary of 435,000 and his expenditure is 285,000. And I've calculated tax, it's more or less 150,000. So I made it very simple in order to illustrate the principles. Now let's assume that he receives a taxable bonus for whatever source it may come of 165,000. So he approaches you and says, now I received the bonus, 165,000. I want to save on tax because my concern is all this tax that I have to pay, it's my money. There comes the fear and the greed factor creeping in. He says, my concern is I don't have enough money for this expenditure. And I have two very important goals. The one is, let's use the post-retirement medical expenditure, something that we must watch in future because people live longer just because of medical. So that is something real. And we also assume that there's university fees to be paid for his two children. So let's assume, simplified, those are the two goals. He got a bonus. He's paying 150,000 tax. He comes to you for advice and say, now what do I do? How do I go about? We know by now. Where do I get the best tax benefit because I'm paying 150? You will be leaded onto the wrong path. How do we go about it? Well, let's have a look. First of all, let me explain the tax calculation and the cash flow, and then we move on to the financial planning principles. There we go. Income side. You've got your salary 435. You've got your annual bonus 165. So your total, and note these words, remuneration. Total remuneration is 600,000. Household expenditures 285,000, and the income tax payable, as I pointed out before, it's 150,000. He has a surplus of 165,000, which is now obviously his annual bonus, which he needs advice on. So just to show you the tax calculation, and this is the current tax tables, which will change after the 20th of February for the next year of assessment, perhaps to a smaller extent than previous years, we hope. So here we go. So let's have a look. Gross income is 600,000, and that's made up of salary and bonus. Read on that remuneration. That's his total income. He's not contributing to a pension fund or any retirement fund, hence I have naught in there. And then we go and we calculate the tax, and you'll see I got to 151,000. And I've just rounded off and made it 150,000. Right. So let's start planning. First of all, let's assume, or let's see what's the maximum he can contribute to a retirement annuity. Now I told you, it was 27.5% of the greater of remuneration or taxable income. So have a look on the right-hand side with the retirement annuity fund contribution. There you see the 151,000 tax due, the one I've showed you just now. But if he would contribute to 165,000, which happens to be, I manipulated it, 27.5% of 600,000, where the remuneration is 600,000 or taxable income. Now in practice that may differ, so you've got a choice of the higher, but not higher than 350,000. Now this is the simplest that I can explain. 27.5%. And last year we did a webinar where we explained you can even take capital gains tax into account. You can go and look in the webinar, and there the tax implications were really pulled apart. But in this particular instance, I make use of my 27.5%, so that those monies, the full bonus, I put away. But look what has happened. my tax is reduced to 90,000 when I do the tax calculation. So on the left-hand side, when I go back to my cash flow and say, you know what? My salary is 435, household expenditure is 285, my tax is only 90, because my 165 I took and I paid it into a retirement annuity. I have a surplus of 60,000 rand. So now I'm actually, and this is one of the very few instances where salary taxpayers can make use of the massive tax breaks, making use of these two vehicles that I'm discussing today. So now we have the surplus, right? So remember the goals, post-medical expenditure, right? So just for example, we put away 165,000. We've got 60,000. What are we going to do with that? Well, let's just revisit the tax-free savings account, and we're going to make use of that. To remind you, remember you can contribute 33,000 per year per taxpayer after tax monies. You don't get a tax break. There's no tax deduction. You didn't see it there. You get a 500,000 lifetime contribution limit. No income tax, dividends tax, or capital gains tax on the growth. No deduction for the contribution. And it's ideal for medium to longer term goals such as education, holiday, etc. All right. So let's now use that in our calculations. On the left-hand side, you will see there's my salary and annual bonus. And on the right-hand side, household expenditures stay the same. My income tax has dropped to 90. I've put away 165,000 cash flow into retirement annuity, but I used the maximum of 33,000 and I put it in a tax-free savings account. So actually revenue is paying me to put the money into the tax-free savings account. And over and above, I would have surplus money available of 27,000. See how I improved my cash flow by making use of tax. Now, this is not complicated tax planning. I'm just simply using what is available out there. But what do I get to do? I get to reach my goals. So let's have a look. So here, the post-medical expenditure, I've just done some calculations. So if I would do this every year for 15 years, that is 6.8 million that I would have available in 15 years' time. And with medical contributions to the medical aid, it's a monthly thing. I can do that. I've got a lump sum that I can make use of if I need a lump sum. It is flexible. Medical expenditure is deductible. So if I would receive these taxable deferred annuity in later years, I can offset that with the medical credits if it's still available then. Very tax efficient, because the retirement annuity, medical credits, and tax-free savings, they're available to all salaried taxpayers. But now I've changed the facts a little bit because this question always comes up. So in my example, I said 33,000. I'm going to contribute towards a goal. But this person, he's got 2 children. So he asked me, Errol, I've got this spare cash. What I'd like to do, I want to put away a tax-free saving for each child. And the child is a minor. Is that a good idea? Let's explore that. Because people, what they think immediately, tax-free savings, I can optimize 2 children. But you have to see the whole thing through and the bigger picture. Now, number one, if you would do that, let's assume 25,000 for each child. In such an event, if you do the calculations, you will have 10,000 more into your bond in this example. You can actually save quite a lot, up to almost 500,000 for your child in 10 years' time. In present value, between brackets, I've calculated it back, is 270,000, which is about for a 3-year course should be more than enough. Now remember, this money came from tax savings. You didn't have it. It's just because of planning. But is it a good idea to put it in your child's name? Well, number one, children grow up. So when they become 19, he decides, studies are not for me, and I'm going to blow it. I'm going to buy a car, or I'm going overseas. It is my money because you gave it to me. So that you lose the control over that. And that could be problematic. Now, we don't know what kids are going to be in future. Secondly, if I would put in my child's name, would there be donations tax? Well, you can donate up to 100,000 without paying donations tax. So that should be pretty okay. There won't be any donations tax. But that is not the only issue. What is important with the tax-free savings investment is that it's done with after-tax money, but as I said earlier, the real benefit kicks in if you're in a high tax bracket at later years, at 45%. And as I pointed out earlier, if you don't pay tax, what is the point in having a tax-free investment? So I would put it in a minor child's name. At the age of 18, he won't receive an income. Really, how much tax have I saved? And then also the last one, which is more border on tax advice, so I'll just give you a factual and I won't stand in for it. But from an income tax point of view, investment in a minor child's name is deemed to be that of the parent. It's a Section 7.3 of the Income Tax Act. And the question is, would that be applicable? It seems that is not the case because it is income, it's exempt income. But I don't think, and to the best of my knowledge, that there's certainty in the respect of the capital gains. So I'll put it out there, there is a possibility, unless someone there was an opinion about that or not, which I'm not aware of, it does run the danger. So when I look at it, there are more negatives than pluses. So really, don't be tax driven. Take the 33,000, see how much you can get every year. Maybe mommy is still there, but yes, you may do that. And if you look on websites, people say, yes, you may do that. Of course you may do that. But what are those consequences? And those are the 4 issues that I spoke about. Okay, so let's assume he only took 33,000 and put it away. Then a surplus in a bond would have been 27,000. What is the value of that? If I would invest an additional 27,000 per annum and my bond is 1.5, I think I worked on 8% rate, interest rate, then you can reduce your term by 6 years. And those 6 years, I can actually save that money. Do you see how I changed the financial position of this client? By making use in a responsible way the tax benefits, how it improves the cash flow, and I allocate that to my specific goal that I want, making use of the correct product. And that is how I submit one should actually go about. There's some other non-tax related features. Let's just run through them quickly. With a retirement annuity, for instance, and I'm comparing a retirement annuity and a tax-free savings investment, because some of these features may be important for some people, some clients. We all are unique. With the retirement annuity, it is protected by the Pension Funds Act. It is protected against creditors. There are limited instances, and even with divorce cases, we saw there was a lot of development and changes in legislation because they had to bring it into the ambit of a divorce case. So it took our courts and legislation quite a while to attach the pension benefits of another spouse. But this is the situation today. So that is an exception. But business creditors, yes, I will have protection. Tax-free savings investment, nope, I don't have. If it's in my name, it would be part of my assets. If it is in my child's name, well, that would be a benefit. They cannot attach that of a child, but bear in mind what I said earlier. With the retirement annuity, I said you give away something. You get those tax benefits. But the government wants you to use those funds so that it's for the benefit of the beneficiary. So for you one, but also for your dependents. So you don't get to choose exactly who's going to receive those benefits. And that is in terms of the Pension Fund Act, and they will prescribe and say, for instance, let's say you would disinherit your spouse totally, but you have a retirement annuity payment. Then the trustees will say, you know what? She is a dependent because she's married, and therefore we will allocate a greater portion towards her, over and above the Maintenance of Surviving Spouses Act, which you may lay a claim against a husband. And that is the rule in South Africa. With a tax-free savings account, well, you cannot bequeath the tax saving. But the amount that you receive from the tax savings, you can actually give to a child, bequeath it to him in terms of will, and he can start his own tax-free savings. Just remember his limit to 33,000. And you haven't used up his because you put the money as in there. He still has it available. Investment strategy with retirement annuity is slightly more conservative, although it's not that conservative, but it's a Regulation 28, where a tax-free savings account, you can really have a lot of growth assets in that portfolio because it's long-term. Now, equities may seem to be very risky to most people, But once you've got term on your side, equities are not that risky, and it's actually a no-brainer in the long term, coupled with the capital gains tax saving. Excess contributions to retirement annuity, remember, you don't claim it this year, you can contribute more, you can claim it next year. If you still haven't claimed all of it and you're still contributing when you retire, you can take it as part of your tax-free amount. If you don't take a lump sum tax-free, you can actually offset it against your annuity income. You will never ever lose it. Tax-free savings investment is the opposite. If you contribute more, I will hit you with a penalty of 40%. And that is just crazy. No, you may have a tax-free investment with this company and that company, but the combination, because it pertains to the taxpayer, is 33,000. Estate duty in a retirement annuity, there is none. Nothing. There's no taxes whatsoever. But on a tax-free savings account, you get all the tax breaks, but the estate duty, nope, you don't get that one. Retirement annuity, proceeds available on the retirement, lump sum to a maximum of 1/3, tax-free savings investment, the full lump sum. And I think those are all the factors that one has to take into account, and how tax is integrated into all of that. So let us think, let us finish off then, and just remember why we are doing it. And I remind you, as you should know by now, those of you who attended the webinars, it is the why. Why are we doing it? People have different reasons. We have created value with tax-efficient investments. But why are we doing it? Not to save on tax, but they are to give purpose to it. And in my example, the giving purpose was to provide for the education of my children, and also to provide for post-medical expenditure. So therefore, the creating of the value balances out with the giving of purpose. And what you have witnessed is what a financial plan should be all about, taking into consideration tax, cash flows, process of goals-based financial planning. And there we go. So there you'll see in the third quadrant, to save and invest, passions and legacy. Well, there were none. We had 2 other goals in our particular instance. But when you speak to people like Warren Buffett, Bill Gates, then definitely their funds are going to passion and legacy, something that we see more and more these days. Just to remind you, plan and protect. The question can be asked, I'm contributing towards a tax-free savings for my child. What if I pass away after 3 years? This is exactly what life insurance is about. Life insurance is not inheritance. It is actually to ensure, because further contributions cannot be made, I cannot create more value. Therefore, I've got to peg it and have that lump sum I was working towards in terms of a life policy. And this is where financial planning and risk planning is important. What is the role of the financial planner? Hopefully by now, is to take you through a process that I have done here. And it is not to give tax advice or the best tax advice or which product is the best from a tax perspective. That should be clear. The aim which the client and the financial planner should work together towards is to identify the lifestyle goals and what is the best and efficient way to get there. And therefore, one is a team, where it's the client, the financial planner, and then Standard Bank team, the other colleagues that we have to assist us and to give us the backup. So I hope that made sense and that you've learned something from it. If you need to know more about the tax implication, go to a previous webinar where I unpacked it in absolute detail, the tax implications. If you'd like to speak to a Standard Bank financial planner, you can estimate the word guide, there's the number, or you can call that number, or you can even email us. Our disclaimer, and then thank you. So Katiba, let's see if there are any questions that we can deal with.
All right. Okay.
I'll go, so I'll just take it, thank you. Right, I'll see how many I can answer here. Hello, I can't hear or see any. Okay, the sound was cut off by the organizer. Okay, is the 33,000 a yearly limit? Malula? Yes, absolutely. It's 33,000 per taxpayer. Your spouse also, she has 33,000, which is a taxpayer in own right. It doesn't mean that you have to submit a tax return. It's not what it means. And while I'm at it, it doesn't mean your investment is limited to 500,000. You may not contribute in total more than 500,000. If that investment would grow to 10 million, the 10 million is exempt from capital gains tax. Can you continue claiming, Ian Smith, can you continue claiming tax deduction for annuities after you have retired? Yes, as I said, it's rolled forward. And if prior to retirement, it's rolled forward to the next year. And what happens when you retire and you would contribute towards a retirement annuity or another one, which is possible, there's no limitation like in the old days that at the age of 70 you may not contribute. You can contribute for as long as you want. And as long as you contribute, absolutely, you're a taxpayer and you're entitled to that. I draw a pension but still contribute to another RA. It is possible. I'm retired. Let me just scroll down. I am retired age 67, but wife is of age 62 years, and can we still open a retirement investment with income, I would say, from selling units? Okay, let's just get that. What is the real question? Can I open a retirement annuity fund age 67, 62? There's no time limitation. You can do so. And then with investment income from selling units, or let's just say any income that you receive. Remember, 27.5% is based on the highest of remuneration of taxable income. Your test is, if it's included in taxable income, which include capital gains, when you say selling units, it could be a capital gain. Yes, you can take that into consideration. There are some limitations. You can go back to the previous webinar that I did. Yes, a compliment, Ketiwe. Ketiwe had a fantastic session. I'm joining you all the way from the Middle East in Qatar. I'm pronouncing it correct. Qatar. I am a Qatar. Say it. You say Ketiwe better than I. I'm a South African tax resident. Would like to know how claiming investments I have in SA affects me with respect to RA and tax-free savings account, which I currently have with the Standard Bank. Your point of departure is: are you a resident of South Africa? If you're a tax resident, you're a taxpayer. Where you stay is immaterial because you still enjoy the privileges of our country, the safety, security, etc. It means that you are a resident and therefore you are liable for tax. In order not to be a resident, then you have to formally immigrate. You've got to show me some papers, and in such an event, you will not be able to have all those benefits in South Africa. But this is clearly not the case. Your keyword is there, residency, and sometimes if you're not a resident and you stay in South Africa for a couple of days, 92 days, etc., there's a whole test, then you can actually be deemed to be a resident. Katiba, where can this webinar and previous webinars be accessed?
This will be saved on the Standard Bank YouTube channel. You will receive a thank you note in 2 days' time maximum, which will have the link for you where you can go have a look at this recording.
Here's another one. Can you reinvest the returns from a tax-free savings and also tax-free? Well, that's actually what's happening, because if you get the returns in a tax-free investment, I said the compound growth, that is actually reinvested. Yeah. If it would mean that when I take my funds from a tax-free investment, or let me put it to you differently, you can't take funds out of a tax-free investment and think you can put it back. Doesn't work that way. You take it, there you've enjoyed the benefit, and then you can still work onto 500,000. That's why the same applies to death. Better to give the child then perhaps the lump sum, and he can then start investing into his own tax-free savings investment. And that was Seragi. Okay, and I think that is about it, Kitiwa. Yep. There we go. Okay, thanks, Kitiwa.
Righto. Thank you, guys. I hope you got as much as you needed from this session. Thank you, Mohammed from Qatar. Very interesting that we are all the way in Qatar. We hope you got your answer there. Just remember, guys, if you would like to carry on with this conversation with the financial planner, you can walk into any Standard Bank branch. Financial planners are available there. Or like you saw on the previous screen, you can SMS guide, the word guide, to 31791. Or you can email spfccallcenter@standardbank.co.za, and a financial planner, financial advisor will call you, and you can set up some time and sit down and carry on with this conversation or any other financial planning conversation you would like to have. We hope this was beneficial. Thank you very much for sitting down and attending this webinar with us. We have one every month, and closer to the time, we'll send you the invite to the next webinar. We hope you have a good day further, and we'll see you next time. Goodbye.